egg yolk, what is going on, viewers of the tube? My name is Tyler and welcome to the channel that brings a wholesome view to the crypto space. Almost as pure as Christian and the Lion's reunion with his master trainer.
I wish you love. And I
will always love you. It's time for Chico Crypto. Speaking about a wholesome view, today we are going to talk about something I haven't heard any other speak about on crypto YouTube, expanding Bitcoin's supply over the 21 million coin limit. Now I know some of you are like, what? I thought it was impossible to create more than the hard-coded 21 million limit. Well, yes, actual Bitcoins. If you examine the Bitcoin blockchain and all the public wallets today, it would add up to the nearly 18 million BTC that have been mined. The Bitcoin blockchain is a public ledger and all balances are visible. So how could one inflate the supply, and is this going on right now? Well, yes, a centralized entity like an exchange or even a custodian who is entrusted with keeping a client's Bitcoin safe could inflate the supply, basically by fractional reserve banking or trading. For example, gold. Gold has been a disappointing store of value for the past 48 years. 1971, the Bretton Woods system was abandoned when there was no longer enough gold to cover all the paper money in circulation. This was announced by President Nixon.
Accordingly, I have directed the Secretary of the Treasury to take the action necessary to defend the dollar against the speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interest of the United States.
The USD became a fiat currency backed by nothing more than the health of the US economy and the promise of the US government. The official end of the gold standard ushered in fractional gold reserves and floating exchange rates. By 1972, the Chicago Mercantile Exchange, CME, launched gold futures trading in 7 fiat currencies. Now remember, just like CME Bitcoin futures, these futures were paper-backed and just speculating on the gold price. Basically, paper gold, the first time gold supply was being inflated. This was good for the price initially as gold surged, but by the 1980s there was an extremely sharp expansion in over-the-counter trading in currency, gold futures, actual gold, and the beginning of online algorithmic trading. Here, paper gold was being created on a scale never seen before, and the price of gold suffered for 20 years because of this. By 2003 to 2004, a new type of gold hype was released, but once again could inflate the supply. Gold ETFs, with the first US one being the Spider Gold Trust, which today is still the most popular gold ETF. And it exposes investors to the price of gold, not physical gold. Yes, if you invest in Spider's GLD ETF, you are not entitled to any gold, like from this article. Ordinary investors can't just go to London and redeem their bullion. Only authorized participants are allowed to create or redeem shares. Authorized participants are registered broker-dealers or other security market participants, which have entered into agreements with the trustee and sponsor. These include major Wall Street names like Citi, Goldman Sachs, Morgan Stanley, JP Morgan Chase, and Merrill Lynch Bank of America, among others. So why do you think this is like this? So a gold run could never happen, because they don't have the reserves backing it up, which many people have investigated and confirmed. The fractional reserve aspects of gold ETFs. Gold ETFs, what lies beneath. Both articles are included in the description if you want to check them out. And the price of gold due to this new inflated supply? Great in the beginning, but just like when futures launched, within 10 years inflated supply aspects started to take hold, crashing the price, especially when Fed QE started ramping up. All the way back in October of 2018, I explained exactly what happened with this gold ETF, a pump and dump. It was an epic theft from 401ks. Now, who do you think were the first people being able to invest in these ETFs? Banks and the elite. They were able to get their sticky hands involved with the financial instrument so much earlier than a person with a 401k account. As we can see from this chart, central banks' holdings of gold started a positive trend in 2005 with an extremely sharp increase just after. And right before the dump of the price of gold in 2012, the banks sold off in 2009. Did they see something we didn't? Of course they did. Now, looking at the chart of their holdings of ETF assets for gold from 2003 to today, a very similar chart, a pump and then a dump, around 2012, which still hasn't recovered. And now this same inflation supply tactic is coming for our Bitcoin. First, CME launched their Bitcoin futures in late 2017. CME never holds the Bitcoin, just trading paper Bitcoin back and forth. This is fake Bitcoin that takes away from the spot market, creating more Bitcoin than that are actually available for trading. So CME just put out a report on October 11th, and they have the data from the past 20 days, from October 11th to September 16th. Adding the total contracts traded, we come to a total of 92,303 CME contracts, and each contract is 5 Bitcoin. Thus, about 463,000 Bitcoin were created and traded in just 20 days, without complying to the economic rules of the Bitcoin blockchain. And going back to that CME report, look on what day the most contracts were traded, on September 24th, right before the Bakkt dump. I can guarantee you almost every single one of those was a paid-for short, as CME is still paying their clients to trade on their exchange through their passive volume market maker program, where they give their clients incentives to create volume. This program was supposed to stop in February of 2019, but was extended to February 2020. But that day was the Bakkt launch, the product coming to rival CME with physically backed and settled futures contracts. Launch day was a disappointment, only 149 Bitcoin traded as their contracts are for 1 BTC. They had their biggest day on October 9th, when they hit 224 BTC traded, but still nothing compared to the inflating pressure on supply by CME. Although Bakkt might not even be a good thing for Bitcoin. Still to this day, Bakkt has failed to provide their Bitcoin warehouse's public address, so we the public can verify that they're actually holding those BTC. And they have been asked for it, and on all occasions declined to give a statement or reveal it. Why in the hell not is my question. Do the clients of Bakkt at least have this knowledge, or are they trusting that their custodian Bitcoins, aka Bakkt Bitcoins, are fully backed just on the word of Bakkt, as Bakkt acquired the custodian who is keeping an eye on the BTC? Problems will arise when investors and the services we use today take Bakkt Bitcoin being just as good as real Bitcoin, and Bakkt or custodial Bitcoin is being transferred and not the actual BTC. And it's not only these big products we need to be worried about, it's the current unregulated crypto exchanges, which don't have to provide any proof of reserves to anyone. Just looking at the current Bitcoin volume, pretty much $15 billion in BTC traded today, which if you divide that by the price of BTC, you get roughly 1.875 million BTC traded. And then looking at estimated transaction value among moved BTC on that same day, only 145,228 BTC. Now I know exchanges have their own system, ways of depositing funds and transfers, but this disparity signals to me many exchanges are running on fractional reserves. And that is why there is a social movement event called Proof of Keys, which takes place on every January 3rd.
This Proof of Keys celebration, what we're going to do is we're going to withdraw all of our Bitcoin from any third-party services just to prove that they're there.
And it calls for all crypto traders or investors to remove their Bitcoin and crypto from exchanges. So those exchanges are forced to show their reserves. And the last one was intense. Quadriga CX, HIP BTC fails proof. Bitfinex fails proof. Poloniex has issues. Purse.io fails. Robinhood fails. Coinbase halts trading. Cryptopia entered liquidation. This is when Tether had 850 million seized and Binance hacked for 40 million. But did this make things any better? Obviously not. Thus something just might need to be done at the protocol level, and this is hopefully coming soon. Bitcoin Improvement Proposal 127, Simple Proof of Reserve Transaction, has been submitted, and there is an open source tool right now for exchanges to easily prove their balances without having to generate a live transaction or exposing themselves to risk of moving funds. The solution is out there, easy to use and accessible to anyone who knows how to run a CLI application. The hard part won't be getting protocol level reserve functions. It will be getting exchanges and the institutional custodians to use it. It's going to be a weird world in 20 years when someone tries to pay me back with an exchange or custodial Bitcoin, and I will only accept it using the outdated old Bitcoin core, aka that real pure stuff. Right, Mark Cuban?
I have bought some. I bought it through an ETN based on a Swedish exchange because that gave me liquidity. As
Pure
opposed
Bitcoin?
Pure Bitcoin, yeah.
Cheers. I'll see you next time.